Content creators and online entrepreneurs making over $250,000. If you ever ask yourself, I wish I had a financial playbook for everything related to my taxes, my cash flow, investments, insurance, legal, and estate, this video is for you. So let's get started with the legal entity. And if you ever ask yourself, I don't know what type of entity I should be, whether it's an S corporation, a Schedule C, a C corporation, does it need to be a partnership if I have another partner with me? Let me go ahead and answer that question here very easily. And in the example here, we're assuming this entrepreneur or this content creator, business owner makes about $250,000 a year. Okay, so let's go ahead and zoom in and let's talk about the legal entity here. So with the legal entity, most people, when you start making money, you are what's called a Schedule C. So there is really no asset protection. You're a sole proprietor, you're making money, you don't need an LLC, you just report that income on your personal tax return, which is a 1040 on Schedule C. For tax purposes, though, it's not the best because there is an additional tax called self-employment taxes, which is about 15.3%, in addition to whatever you're paying for federal, in addition into whatever you're paying for state. So there's kind of like three taxes here with Schedule C. The next option, which is what's called an S corporation. So maybe a lot of you have heard what the S corporation is and what it does. I have an example below where I'm going to go into detail, and I also have a video here where I talk about S corporation. So go ahead and check that out. An S corporation is great because it allows you to take part of your income as a W-2, as an employee of the business, and the difference goes as what's called an owner's draw, but on the tax language is called a K1. And the great thing about this structure is that you don't pay self-employment taxes on that difference. I have that entity design and we'll talk about that later. The third design is a C Corp. So most of you are not going to need this. So 99% of all business owners in the US, again, I don't know what the statistic is, but I'm just assuming it's probably over 90% of small businesses are structured as S corporations or their Schedule Cs or their partnerships. There's a very small minority of business owners that use the C Corp. So think of a lot of businesses that are startups that have a lot of losses in the beginning, right? I'm not going to go into all the complexities of the C Corp, but C Corps have a double taxation system where you pay a flat tax at the corporate level and then you pay dividend taxes at the shareholder level. So there's two rates per se for C corporations. They're not the best, and I would say don't use a C Corp unless you are some sort of tech startup or you plan to be at a loss for anywhere between 3 to 5 years. And the last one is a partnership. So this is probably one of the most common as well for people who are going into a joint venture. So let's say, for example, you and your friend are starting a power washing company together. You would form a partnership, and then you would say whether that's 50-50, whether that's 60-40, whatever the case may be, there needs to be a specific operating agreement that lays out all the structure, how people are going to get paid. If you are going to go into a partnership, I would just recommend talk to an attorney and make sure that operating agreement is clean, because the amount of times business owners, after years of working together, end up with drama, and then they're fighting over whose is what, and what their ownership is and what they should have been paid. So if you're going to go into a partnership, it doesn't matter how much you love this person. I would just say go with an attorney, pay the $1,500, get it done. This goes to online entrepreneurs as well, content creators. Make sure that you have your operating agreements nice and clean. Okay, so that is a quick overview of the legal entity. So let's go ahead and go to the tax strategies. Let me make sure my head is out of the way there, and let's zoom in a little bit. So let's go over these very quickly, and I have videos for these individually, so feel free to check those out. The home office deduction is likely the most underused strategy out there. This is perfect for those who are content creators, who are making videos, who are using their house. You don't have to be a content creator. You can be a coach. You can have courses. You can do anything. But if you're using your home exclusively for business purposes, you can use two methods. You can either use the actual or you can use the simple method. And again, it's too long to go into this, but you can use a specific calculation for each, make sure which one is best for you, and make sure you talk to your CPA. The 280A, also known as the Augusta Rule, which allows you to deduct your personal property for business expenses for 14 days out of the year. There's a lot of nuance to this strategy. It needs to be done right. There's probably one of the most abused strategies out there where people think their property is worth, I don't know, $2,500 or $5,000 per day, which is obviously probably not accurate. So make sure you have comps that can support or justify the rental expense. Again, I have a video on this. Go check it out. Okay, so that's 288. So the auto deduction, believe it or not, a lot of content creators, entrepreneurs are using their car to go meet clients or go to shoot a video, to go to the store, to buy a laptop. All of that is business expense. So either pick, again, there's also an actual and there's a simple method, right? Or the mileage. Again, you have to make sure which one is best for you. Are you driving a long distance with maybe a super cheap car? Then maybe the second option is better, the mileage version where you just multiply it times a specific flat amount that the IRS gives you. Or the actual method, maybe you bought a super expensive car that is related to your business. I don't know, a G-Wagon, right? Everyone wants to deduct a G-Wagon. Maybe it makes sense to use the actual method where you take a percentage of use, right? Maybe it's 50% of business use. Maybe it's 60, maybe it's 100%, which most people just put everything on the business, right? When in reality, maybe it's not 100%. So let's make sure we understand what the business use is for our car. This can save us anywhere between $10,000 to sometimes $50,000 in taxes every year if we deduct the car properly. And these two over here are retirement accounts that a lot of people just do not have. So the SEP IRA is for business owners, and this is probably great for those that I'm like, I don't know what I'm doing. I just need to put something aside. I would recommend look into the SEP IRA because it's really cheap. So the SEP IRA allows you to deduct up to 25%. Let me zoom in over here. 25% of your income, right? So basic math there. If you make $100,000, you can contribute up to $25K, right? Now that changes a little bit if you have an S corporation. Remember, with that S corporation, you have that W-2 component, that salary. So if you have an S corporation, it's based on your salary, not the income of the business, right? So just a quick tip there. So once you graduate, I would say maybe once you start making 100 to 250, anything over 250 to 500K, then you definitely want to look into what's called a solo 401k. Now, I could spend a whole video on the solo 401k, but just for people here really quickly, with a solo 401k, and you're like, hey, I want to put in $50,000 to $70,000 into this. This would be a great option. So with the solo 401k, there's two, I would say, I don't know, parts to this. So there's the employee portion that you can contribute. I don't know, that's 2025. It's probably somewhere around, I think it's like 21K or 2,500 that you can contribute on the employee side, right? So that's how much you can contribute. No questions asked. And then there's the employer part, right? So kind of like the SEP IRA, you can contribute up to 25% of the income that you're earning in the business. So again, if you're just a Schedule C, that would be 25% of, let's say, for example, 100K. Then you would contribute another 25K here, right? So that's the beauty of the solo 401k, is that you have this additional, what is this? I can't math. But anyways, let's do, what is that? 46K that you can contribute in addition, sorry, not in addition, but relative to the SEP over here, where you could only contribute, let's say, 25K, right? So anyways, in summary, the solo allows you to contribute a larger amount. Now, there's some admin expenses that you have to pay every year. So maybe like $500 to $1,000 every year to have all the reporting. And then if you have the 5,500. So there's a lot of other admin things that you have to keep in mind. So I would say it makes sense once you start making around 200 to 250K. Okay, we're going through investments. We're going to try to do this as quick as possible. So let's zoom in here and talk about investments really quickly. So like everything else in finance, it's very risk dependent. So I can't say, hey, you, a specific person that you're, watching this video, you should be XYZ. I just don't know your situation. I can't give you a personalized or tailored financial planning or investment advice to you because I just don't know you. So it's very dependent on your risk. Are you very aggressive? Are you a little bit more conservative? I'm going to talk about some general rules here for people who own their own business and how you need to view risk. Okay. So just quick disclaimer there. Just depends on your situation. Overall, if you're, kind of wanting to DIY yourself, or you're trying to DIY this yourself, I would try to focus on low cost ETFs. So ETFs are essentially just think of it kind of like a basket. When you go shopping, right, you put, maybe apples and eggs and chicken, whatever you go, and it has this basket of goods. So think about the ETF. It's kind of like a basket of businesses. So you buy one share and you own all 500 shares or 1,000 shares of whatever index it's tracking, right? So you want to make sure that you're buying a low cost ETF, right? So for expense ratios, the example here is that I have $100,000 of assets under management or invested, however you want to look at it. If I have a 1% fee on that mutual fund or ETF, then my expense per year is going to be $1,000, right? So it can get pretty expensive. So as I was saying here with VTI and VOO, is their expense ratios are like super low. So it's like 0.02%, which is like nothing. It's like $2 a year, right? So super cheap. So that would be the recommendation there. And here's something that's probably going to sound a little bit more controversial here. Likely, you will want to be a little bit more conservative as a business owner. And you're like, what the heck are you talking about, Steven, right? Like, I'm probably young. You're probably, 20, 30, maybe 40s. And you're probably thinking, why shouldn't I just invest everything 100% into the stock market, right? Because I'm young. Again, I need to zoom in over here. Why don't I just put everything into the stock market? Well, here's my opinion, and this is just my opinion alone. I think as a business owner, you are already concentrated in your business, right? You already have a company. You already essentially have stock in one of the most valuable assets, which is your company. So when I tell my business owners, like, hey, do we really need to be 100% into the stock market because they're super young? I'm like, it's probably not a bad thing if you have the risk and it meets your specific situation and you want to do it. Sure, I think it's great. But I think we miss the fact that most business owners are sometimes kind of cash constrained. So if something happens or they have a lumpy year where cash flow is all messed up, which we'll talk about cash flow as well, they'll need to tap into something else. You don't want to be your 401k sometimes, right? So you want to have cash aside or investments aside that are a little bit more conservative. So me personally, I am not a big Bitcoin fan if you don't have cash on the side. Do you want to add a little bit of Bitcoin to your portfolio? Sure, go ahead. But I don't think entrepreneurs should just put all of their excess cash, right? This is aside from the business, into other more risky ventures. I think this is your opportunity to be a little bit more conservative, keep some cash, maybe some other, maybe dividend ETFs or maybe bonds that are a little bit more conservative, that if something happens to your business, you have access to that cash. Okay, that's all I'm saying. Let's go ahead and move on to the next topic, which is cash flow. Let's make sure this looks good. I don't want to cut everyone off here. So As a business owner, if you're a content creator, you're definitely have irregular lumpy cash, especially if you have any like brand deals or anything like that. You guys have a lot of lumpy cash, so you need to learn how to manage that. So I would just keep some sort of calendar of where your income is coming, where it's going. I have an Excel spreadsheet. Feel free to DM me. I'm happy to send it for you at no cost. So you have to keep a calendar, a cash calendar, and a projection of where you think the income is going to be. Why is this important? Is because you are going to have to pay estimated tax payments. And this is for Q1, Q2, Q3, and Q4. And look at the schedule of the IRS. It's a little bit different than what we think Q1, Q2, Q3, and Q4. So make sure you pay those before the deadline. Otherwise, you will be penalized at the end of the year. So make sure in your cash flow calendar that you account for these. Okay. And lastly, over here, the last tip is just set aside about 25% of everything you earn for taxes. So if you get a brand deal for 50 grand, make sure you keep 25% of that in another bank account for taxes. Don't even touch it. Make sure it gets whatever, 3 to 5% interest rates. Then by the time you file your taxes, you have this little bucket that's ready to go that you already earmarked for taxes, okay? Okay, next one is insurance. So regardless of what you're doing, you need general liability. So if you're a content creator, power washing, or landscaping, or those guys that like landscape for free, right? It doesn't matter that you're doing it for free. You need insurance. You accidentally, I don't know, hit a nail, that then the nail hits the car and then the person sues you for that. You absolutely need general liability. So go ahead, go to any insurance agent that you know, make sure you get this quoted out. This is probably also recommended. It's called E&O, professional liability. If you're online, it's probably known as media liability. So talk to your insurance agent, see if this makes sense for you. If, for example, you say you call someone out and you're like, oh, I think XYZ person is dumb, I think they're stupid, or you're doing some React content and they try to sue you for this, this is when the media liability will kick in. Obviously, there's a lot more nuance to that, so make sure you talk to an insurance agent about that. For other people that run their business online, cyber insurance typically is recommended. So if you're held for ransom or they take over your website, cyber insurance will kick in and try to pay some losses there. Lastly, and this is a maybe, this is what's called EPLI. So this is employer practice liability. So this is if you have an employee and they want to sue you for some reason, you said something dumb on the internet and they felt offended, where everything is offensive these days, they can sue you. And if you live in California, New York, Hawaii, Florida, I think Texas might be high. But anyways, if you live in any of those 5 states, then you definitely, and you have employees, then you definitely want to look into EPLI. It might make sense. And lastly, for estates, if you're earning somewhere around $250,000, you probably don't have any crazy, I don't want to say complex asset protection structures. So most likely you just need to set up what's called a revocable trust. So for example, let's say you have a Robinhood account here. You have, and again, I need to scroll over here. You have a Robinhood account right here. Maybe you have an account at Schwab or Fidelity. And let's say all of these are owned by you personally, right? So for example, let's say you die. You die in a car accident. You have no kids, or let's say, for example, you have a sibling or you do have a kid. So if you do have a kid, then you're going to have to go through what's called probate. And again, let me zoom in over here. And probate typically is anywhere between 2 to 3% of your net worth in fees, right? So it's really expensive. So my point is that setting up a revocable trust allows you to avoid probate and allows you to have just a lot more structure on what's owned by you instead it's owned by your trust, right? Okay, so that was a lot, and I'm sure there's a lot of questions there, but let's go ahead and go down here to an example of an entity chart. And for this specific person, I don't know, we can just call her, I don't know, let's call her Lacey. And Lacey here was smart, and she set up a revocable trust. She went to an estate attorney and she said, hey, I need a revocable trust to make sure all of my assets, my S corporation and my rental LLC are owned by my revocable trust. And the estate attorney probably charged her anywhere between $2,500 to $3,000 to get that structured. And now she has a revocable trust, right? So let's look at her income over here. So Lacey has some sponsorship and brand deals. Is this looking good on the whiteboard? Yeah, I think it's looking good. She has some sponsorship and brand deals. Let's say that's $100,000. She does some coaching on the side. So maybe she's like, I don't know, she could be, I saw, recently I saw someone on TikTok who's like not a life coach, but like a relationship coach. And he has like 500,000 subscribers and a lot of subscribers to his coaching program, which he's crushing it. So you can either be like a coach or an influencer. You can sell products, right? There's a lot of people who sell products on TikTok. Anyway, so let's say you make about 100K there. And then other like ads, AdSense, YouTube ads, whatever. You make another 50K there. So all in all, you're earning 250, right? 250K. So this is income, right? This is after your expenses, everything. This is money earned. So let's say the S-Corp over here, because she set up an S-Corporation, she heard about the Schedule C and she's like, I don't want to pay more self-employment taxes there. So she set up an S-Corporation. So like I mentioned before, and I have a video on this, so go check it out. She paid herself a W-2 of $50,000, and that was what was, sorry, and that's what's considered reasonable. And then the other $200,000, right, because she made 250, so 50 to 200K, was taken as an owner's, oops, I gotta zoom in over here, as an owner's draw, right? And that's reported on Schedule K1. So she did this to save self-employment taxes. So I don't know the math here. Let's say this structure allowed her to save 30 grand in self-employment taxes, right? Which is awesome. So then the W-2 goes on to her personal income, which will be reported on her 1040. And then the K1 will also go to the 1040, right? But also, let's say Lacey over here, she's crushing it. She's crushing it. She has all this excess cash flow. She already has her, she already has her SEP IRA. Maybe 1 year she's like, you know what? I'm going to add a solo 401k because I'm already crushing it with my SEP. Solo 401k. So now she has a solo 401k and she's like, you know what? I have excess cash. I need to buy a rental. So she buys a rental property and she goes to the same estate attorney and she says, hey, by the way, Mr. Estate Attorney, I know you did my trust. Can you help me, or do you know anyone that can create an LLC for me? And can you please fund that into the LLC? So the estate attorney might do an operating agreement, which you probably don't need an operating agreement for an LLC, but they'll set up the entity for you, which is asset protected. And what's most importantly, it's owned by your revocable trust. So that's probably the most important part there, is that you want to make sure that the LLC is funded by the revocable trust, right? Cool. So now she has, active income over here where all her sponsorship deals, her brand deals, product and coaching is all going through the S corporation, right? So these might be 1099 income. This might be other income, but you want to make sure that all of this is going to your S corporation, right? Because at the S corporation, then you can figure out how much you should pay yourself and how much should go through as a K1 draw, right? Cool. So I know this was a lot. Hopefully this was very helpful. This is probably, I covered maybe 80% of what most business owners earning $250,000 should do with their taxes, their insurance, their estate, their legal, insurance, entity design, right? If you thought this was helpful, please go ahead and give a like, subscribe, send me a DM if you want those Excel spreadsheets. Catch you next time.